The most famous graph in economics, if not the whole world, is completely bogus. Hello, welcome to Realonomics. My name's Kareem, and I am a recovering economist. What am I recovering from, you might ask? Well, mostly I'm recovering from all the BS I was forced to swallow when I studied economics at university. After leaving university, I discovered that pretty much everything we learned in economics was completely wrong, and much of it actually, when you stop to think about it, really absurd. This led to me relearning economics from scratch, writing a book, and eventually recording this series of videos to share the insights that I've discovered in the intervening years. If you follow along, you will come to understand why the economist John Kenneth Galbraith once said that the only purpose of economic forecasting is to make astrology look respectable. Now, everyone has seen this diagram 1,000 times. It permeates the public consciousness. Everyone understands the basic story of the twin forces of supply and demand. Now, what this graph specifically says is that for every product in every market, there's a price at which the amount demanded by consumers is exactly equal to the amount supplied by firms, and that's where you get this equilibrium outcome in that market. But firms have unsold stock all the time. That's why they have sales every year. If the invisible hand of the market really did balance supply and demand in the way that's claimed, there'd be no fat people fighting over flat-screen TVs in Walmart on Black Friday. So clearly there's something wrong with the story that's being told in this picture, and today I'm going to start off by debunking the supply curve. Why does the supply curve slope upwards in this picture? Well, the story goes like this, that for any given product, as the price of that product increases, more and more firms will be tempted into that market to supply it, and so the quantity offered for sale will increase along with price, giving you the upward sloping curve. But this claim ignores a really important fact. The most important fact. Price isn't important. Profit is. If firms can't make a profit selling a particular good, they won't sell it at all. So actually, the cost of producing that item becomes the key factor. If you can make it for less, you can sell it for less. If it costs more to make, you're going to sell it for more. And what do we know about costs? Well, this is how you can debunk all of economics in just 3 words. Economies of scale. We know that economies of scale mean that the supply curve is downward sloping, because the greater your volumes, the cheaper it is to produce each unit. The more you're selling, you can build a bigger factory, you can invest in better machines, you can negotiate bulk purchase discounts with your suppliers, all of which enables you to cut the cost per unit of producing this item. And if you can cut the cost of producing it, you can sell it for less, you can undercut your competitors, and you can make more money. Now, I put this point to my economics tutor, and his rebuttal went like this. Well, we assume that there are only 2 inputs to production, capital and labour. And we assume that in the short term, capital is fixed. So the only way a firm can increase its output is to hire more and more labour. And eventually they're hiring so many staff, and they're all standing around with nothing to do because they've got too many staff for the amount of machines that they've got, and so it becomes inefficient. And so eventually that supply curve turns upwards. And when we were confronted by this explanation, all of us students sort of nodded and scratched our chins and went, oh yes, eventually the supply curve turns upwards. But of course it doesn't. The claim is, apparently, that the manager of a successful manufacturing company is somehow going to hire 1,000 staff when he's only got places for 100 of them on his production line. It makes no sense. It's never happened. It's never going to happen. It's a completely BS claim. So, economies of scale clearly mean that the supply curve does actually slope downwards, as you would expect. And if the supply curve slopes downwards and the demand curve also slopes downwards, you don't get a stable equilibrium. Not at all. Not even in theory. Not even on paper. Now, why does this matter? It's a bit of an arcane argument, but why does it matter? Well, because the supply and demand model is taught to students on day one of their economics courses. And then every other bit of economic theory is built on top of this particular bit of reasoning. So if this reasoning is wrong, everything else that follows on from it is also, logically, has to be wrong. So by the simple act of showing that the supply curve slopes downwards, all of neoclassical economics is disproven. But I won't stop there, because there is way more BS in economics that needs debunking. I won't be happy until this beast is killed stone dead, because our banks, our central banks, our bureaucracies, and even our political parties are all full of people who believe in a theory that's as relevant to the real economy as Harry Potter books are to physics. So in my next videos, I'm going to debunk the demand curve, because that's bogus too. The very concept of a stable equilibrium model in a dynamic and ever-changing world, and then we'll go on to slay more myths in economics after that. Thank you very much for listening today. I hope this was interesting. If it was, then you can subscribe to this channel on YouTube. You can find Realonomics on Substack, on Twitter, Instagram, TikTok, and all the usual places. I look forward to seeing you again for future videos. Please do join me. Thank you.